There we go. Okay. So, hopefully you were able to listen to that other part of chapter 8 and it made sense. So we're going to get into chapter 13 today. Whoops. All right. So let me wait for Sean to get in here so I can continue going on. Some good news and some bad news. Really, you probably both say, you'll say, that's all good news, lady. But Thursday, I'm not going to be able to have class. I found out last week at my LCC job that I have a meeting I must attend on Thursday at 3, and I'm not sure how long it's going to go. So what I'm going to do is see how far we get with the information in chapter 13 today. And, you know, I'm not going to rush through it and shove it down your throat, but Thursday morning, if I can't do it tomorrow, I teach all day on Wednesdays, and tonight I'm already have stuff happening. I'm going to do a lecture on the remaining part of chapter 13 that I don't get to talk to you about. And then if anybody has, I'll make sure that's in Zoom or somewhere for you Thursday morning. And then if anybody has any questions or wants to meet with me individually before you take the final exam, that's fine. Just let me know if you need me to explain anything further or if something's catching you up, you know, just let me know and we can plan to meet individually. Okay, but that is the plan for that. The final exam is due on the 15th, which is 1 week today at 11:59 p.m. Please don't forget your group comprehensive tax return. One submission per group is due December 13th, 11:59 p.m. And if you should have any questions about that as well, just let me know. Okay. Are there any questions right now? Okay, final chapter. You know, you guys are in great shape with preparing tax returns, whether you realize it or not. You may not feel that way, but you are. Everything comes with practice, but you have all of the major items on an individual tax return, federal purposes anyway, identified, and you've, you know, looked at the different rules. You at least have been exposed to them. So, you know, if any of you are like, hey, I'm looking to do some part-time work, go to a tax place locally if you want. Keep practicing what you've learned, Liberty Tax or H&R Block. They're going to send you through a couple-week course, but you know more coming out of this course than they teach you in that 6-week course. So it'll be a great review, or if you can volunteer to do tax returns through a VITA program, Wilkes University has one. Do it. Keep practicing this because, you know, it's like anything else. The more you use it, the better off you are. You won't lose it. Or if you can do an internship somewhere during tax season, do it. Even if you're like, I'm not going to do, I have a couple students at LCC. Yeah, I won't be doing taxes. I'm like, yeah, I'll see you in a couple of years. We'll see where you end up. Sometimes when we're learning it, it's not as fun. But because it's a lot of stuff, I know, but you'll see, you'll really surprise yourself, I think, even when you start working on tax return or out in the world and you might be doing tax returns. You'll be like, wow, I remember that, and you'll get your confidence with them. So never say never. All right, I'm going to grab my PowerPoint for chapter 13, which incorporates the CARES Act because just a little bit of changes from the CARES Act to retirements. Not huge, but just a little bit different than what your book is. So that is our focus. Retirement, savings, and deferred compensation. Now I already know deferred compensation and certain self-employed retirement plans I'm not going to talk about until my Thursday morning lecture. I already removed them. So I'm hoping to get through these almost 30 slides to introduce you to the common retirement accounts and the tax law from the side of what happens when you're contributing and what happens when you're taking the money out or distribution. And it's funny because today, well, my husband and I have been talking about retirement, and I'm only 52, but I'm lucky I'm in a position that I could probably retire in about 5 or 6 years, not fully, but I could retire a little bit. So, you know, a major concern is if we move to, because we're moving, I'm out of Pennsylvania, I'm sick of the winter, wherever we move, am I going to be taxed on retirement? And it's very interesting. There's only about 14 states, Pennsylvania is one of them, of course, that doesn't tax retirement. So I've already paid income tax on my retirement contributions. And then when I get them out, I may have to pay income tax again, depending on where we move. So things you always have to keep in mind. Now, will it stop me from moving south? A tax? Probably not. But I want to move where I'm not paying a lot in taxes. All right, so back to what we have to learn. Employer provided qualified plan. So retirement plans, guys, you can create your own. We're going to talk about those individual retirement accounts, but most people either have a retirement plan through their employer, or if they're self-employed, a special type of retirement plan designed for self-employed individuals. Qualified plans must be available to almost all employees who are considered, or all employees who are considered, quote, full-time. They meet a certain age, I think it's 18 or older, and there's certain qualifications within the tax law. So you can't pick and choose which employees are involved in a retirement plan if it's going to be considered a qualified plan. There's two major types of qualified plans out there. The first is a defined benefit plan, and the second is a defined contribution. Now, when you see that word defined, it's like saying you defined the word glasses, okay? Defined benefit. So you know what glasses are. You know what the benefit will be out of this plan. So you know what your distributions will be when you're in a defined benefit plan. When you're in a defined contribution, you know what the contributions will be. You don't know what the benefit will be. So we're going to look at both of these because they're both very, still in our world, very active. I'm right now in a defined benefit plan, Pennsylvania State Employee Retirement Plan. So I'm in a pension that when I retire, even if I take early retirement, how will I get paid? I get a certain amount of money at retirement. It's based on how many years I've worked as a Pennsylvania State employee. So my LCC and my Penn State qualify me for this. And it's based on average compensation. Now, they talk about the amount of compensation that can be taken into account for a particular year, determining the employee's benefit, and is capped by an annual compensation limitation. What does this mean? Well, I know when I retire from LCC, I will receive 2.5 times my years of service. So it'll be 25 years when I retire. So 62.5%, 2.5 times my 4 highest quarters of compensation. That is how it's defined in our pension plan. That will be my pension when I retire. And they give me all kind of situations. So if I want my husband involved in it and things like that, but that's generally how they determine it. So I put about 7.5%, 8% of my pay right now into the pension, but my benefit is not defined by how much I put in. but by how many years I work and my average compensation for a period of time. Now, the annual compensation limitation, though, is this: your pension cannot be based on more than 270,000 of pay for 2017, 275,000 in 18, 280,000 in 19, and 285 in 2020. So the maximum benefit in 2020 that you can receive is the lesser of 100% of your 3 highest consecutive calendar years of compensation, limited to the annual compensation for each of these 3 years. So they're saying, if you make more than $270,000, which I don't make near that, okay, I wish I made half of it, but if you make that much or more, well, when we're figuring out, or when they're figuring out how much pension you get, they're stopping at 270 and averaging 270. Then they'll say, look at, or even if it's 2020. Okay, so we limit it to the annual compensation for each of the 3 years, or 230,000. So they're going to average your 3 years. If it's more than 230,000, the maximum benefit is based on 230,000, or that average. And that's what they're saying there. So that is the benefit, how you determine a benefit. So what you'll get from a defined benefit plan. Now, employers who have this, it's usually governments. Okay, government employees are the ones who usually are very lucky to be in this kind of pension plan. The employers, though, if they do offer a defined benefit plan, deduct what they owe as they contribute to the plan. So this is from the employer side. Now, how much do they have to put away? Like, how the heck do they know how much money I'm actually going to make and want to take at retirement? And my son's going to be he's going to main campus after this year. He's at Wilkes-Barre right now for actuarial science. And an actuary tells you that. There are those people who could do all that statistics and math stuff and love that and do probabilities and come up with, here's how much you should put away, employer, so that when Lori retires in 20 years, she will be able to get what you promised. In this kind of retirement, it's the employer who bears the investment risk, meaning the employer must make sure that they put enough away and it's invested in something so that it will accumulate to give the employee what they promise. That's why these plans are going away. First of all, the government runs them, scary enough, but they're promising all of us all this money, not making it. So you'll hear about it on the news. The pension plan is underfunded by this much because it's this kind of a plan. So these are going away. They're not going to be around for long, I don't think. Slowly, they're trying to take them out of contracts for teachers and state employees and federal employees and all who are, like I said, you're very lucky to be in this kind of plan. But that's what it is. If you haven't taken intermediate accounting, I guess it would be 2 for you guys. I don't know if you have a 3, but you'll talk about these different kind of plans and how we do the financial accounting side of it. Now, defined benefit plans have what we call a vesting schedule. Vesting means this: it's how much you as an employee are eligible to take of an employer's contribution and earnings to your retirement if you separate service. Okay, so we have a 5-year, what we call cliff, or 7-year graded. If you turn to page 13-4, you could see this. Page 13-4. So what it's saying is, if you are in a 5-year cliff, okay, if you leave employment before reaching 5 years of service, okay, any money an employer puts into your pension or any earnings from it, you are not allowed, or you don't own them. Okay, you don't own any of it. The only thing you can take with you when you leave service is the money you put in and the earnings. That's it. If you're a 7-year, until you're 5 years, once you're 5 years, you could quit on the day after your 5-year anniversary. Now you're eligible for all of the money that is in your pension plan, which is different than taking the money out at retirement. So like, let's say right now, I've contributed over the last almost 20 years, $200,000 because I'm required to put that much into my pension. And I just quit LCC and quit Penn State and say, I don't want to work there anymore. I'm not doing this. Well, if I'm on a 5-year cliff, I'm eligible to take any money I put in and my employer and go and put it into another pension or retirement plan. I don't have to leave it in this defined benefit plan. Another way of vesting is what we call a 7-year graded. So each year, the employee becomes eligible to keep the employer's contribution based on a percentage. So in the first 2 years, you're not eligible to take anything if you leave, as far as the employer contributions go. Yours, you always take with you. You always own your contributions. But if you leave during or after 3 years of service, but before 4, you're eligible to take 20% of what they contributed on for you. If after 4 years, you're eligible to take 40%. After 5 years, 60%, and then 80%. And then after 7 years of service, you're what we call fully vested. Any money that the employer puts in or you put in plus earnings, you're eligible, that's yours. You could take that with you when you leave service. Okay, so we just want to make sure you understand that. Now, you contribute, your employer contributes, but no matter how much you contribute, you're promised a certain amount at retirement. Okay, now if you leave early before you vest totally, depending on the type of vesting schedule with your pension, you can take your contributions and earnings plus your employer's based on your vesting. Now, let's say you don't leave, you stay till you retire and you start drawing on your pension. Distributions from a defined benefit plan are totally taxable to the employee when they receive them. As I put money into my defined benefit plan, it's kind of like, well, it's not kind of like, it's treated the same way as somebody who's putting money into their 401k. So if I have $1,000 taken out of my pay to put into my defined benefit plan, my employer goes, well, here's Lori's gross pay, subtract the part that is going in to her defined benefit, and the difference is the taxable portion of her gross pay. That's the part we'll report to the IRS as her gross pay to be taxed. And she never pays income tax right now on any of the money that is funding the defined benefit. So because I never paid income tax on any of the contributions that are being made, you pay income tax on the back end when you're taking the distribution out. And it's taxed as ordinary income. Now, no matter what type of retirement plan, the general rule is this: If you take a distribution out before you turn 59 and a half years old, you not only pay income tax on it, but you may have to pay an extra 10% penalty for an early distribution of a retirement. Now, there are certain limitations, certain exceptions. One of them being you became totally disabled and you needed to retire early, basically, and start drawing on your pension. Well, then you still pay income tax on your distribution, but you do not have to pay that extra 10% penalty. So take a look here we're going to go through that whole 59 and a half thing again, but I just wanted to bring it out to you what it is, in case you're like, what the heck is that? Let's take a look at the CBA, the defined benefit plan for CBA. They provide a defined benefit plan to its employee. Under the plan, employees earn a benefit. So they will receive when they retire, 2% for every year of service. So they take years of service times 2%. For every year of service of their average salary for 3 highest years of compensation. CBA has a 7-year graded vesting, so it follows that 13-4 7-year grading. If Tina works for CBA for 4 years, here's her salaries: 60, 65, 70, and 75. Take the 3 highest. And then she leaves work for another employee. What annual benefit will she be entitled to receive? How much will she be entitled to receive? Take a look. Average her 3 highest years of salary. Ignore the 60, 65, 70, 75. So the 3 highest years are 70,000 average. Take her years of service, 4 times 2%. She's eligible for $5,600. Now, if she waits and retires, now the assumption here is that, what's her name? Tina doesn't contribute at all to this. And some employees don't. They're just eligible for it. Since she only worked there for 4 years, she's eligible for a 40% benefit. 40% of the amount she could receive at retirement. Since she contributed nothing, she doesn't have anything owed to her that is hers, so only 40% of what she's promised in full would be allowed. Now, if she had worked for 7 years already, it would be 7 years times 2%, and she would be entitled to the entire 14% because she would be fully vested. Okay, so that's how we would determine the amount she would receive. Okay, let's see before we go to that one. Okay, so that's a defined benefit. You know what you're going to get at retirement. Defined contributions, you know this as a 401k. And at where I work, most government employees, they call their 401ks 403bs. Okay, it's just because it's a government employee. What is this type of, and a 457 is just another plan for another type of employee. I'm not even sure. They're the same thing though. Same exact type of plan. 403, oh, I'm sorry. 403B used by nonprofit organizations like educational institutions. Then 457 are government agencies. Okay. But they're all the same. What happens? An employee contributes to the plan a defined amount, 5% of my pay, 10% of my pay. An employer will typically also put money in Sometimes they call it matching the employee contributions. And there's all different ways employers can define this. They could say, we will put in the same amount of money you do, employee, or we'll put in 25 cents for every dollar you put in up to a certain amount. So it all depends on where you work. But the employee is not guaranteed an amount at retirement. What do they have in retirement? Whatever their retirement accumulates to. So there's no guarantee. So the risk falls on the employee. So it's very important that employees invest their contributions wisely. Okay. When we're young, and they say, and it's true, when you're young, your 20s, your 30s, you typically invest your money in riskier kind of investments, like stocks that are maybe with riskier, newer companies that don't have a long-standing history, because they're risky. But they usually risk, if you haven't had finance yet, lots of risk, lots of return. Then as we get older in our 40s, maybe even in later 40s, we start changing that investment strategy more towards a large stock with a standing history, large company stock with a standing history that has more stable returns. Still risky. Stocks are risky anywhere. And maybe we put some of it in bonds, because bonds are not a risky investment. But then once we're in our 50s, if you are worried about having money at your retirement because you have one of these types of plans, not like less than 30% even to me, I'm very conservative when it comes to investing, but it depends on your risk level. But you're going to take a chunk of that out of the market, the stock market, because stock markets are good for the long haul. You see growth over the long haul. Over the short term, it could go up or down dramatically. And this happened to somebody I knew. She had a beautiful retirement back in the 80s or the 2008s, I'm thinking 80s, but it's like 2008, 2007, and she lost. And no, there was even a crash before that. It was in the early 90s maybe, but she lost a significant amount of her retirement. She was already in her 70s. I mean, it was insane. She shouldn't have even been invested the way she was. So it's really important. I know I'm getting off the subject of tax, but it's really important that employees invest their contributions wisely. And if you're not sure how to do it, you call the person at the investment company. Employers always provide some type of financial advisor from these plans. Anyway, okay, so that I'll get off my soapbox there. But the big thing is employees are contributing and employers are usually contributing. Now, there are annual contribution limits, just like there's caps on how much you can take and be given out of a defined benefit plan. Well, since we know our contribution amounts, now you're capped on how much you can put in. So employees are able to contribute up to $19,500 of their salary if they're not 50 years or older. People like me that are old, we get to contribute up to $26,000. And the reason that is because I'm getting near retirement. You know, I'm closer to the retirement than I'm, far away from it. So they allow us to do a little bit extra. They call it a catch-up. That's just the employee contribution. Employee plus employer contributions are limited to the lesser of $57,000 or 100% of the employee's compensation, whichever is smaller. Now, if you're 50, $63,500. So they don't want you overall putting more between you and your employer into your 401k or 457 or 403b than you're actually making in salary. Vesting works the same way. Vesting contributions and earnings, okay, on employee contributions vest immediately. It's like what I was saying before. Anytime an employee puts money, whether it be in a contribution or a defined benefit plan, that's always their money, and that money and the earnings, they're 100% vested as soon as it happens. It's the employer contributions that they may not have access to because they didn't put the time in to gain access. So the minimum vesting requirements for these kind of plans, this is on page 13-8, a 3-year cliff. And that means you have no access to the employer contributions if you leave in the first, second, or during the 3rd year of service. But once you complete 3 years with that employer, if you leave in year 4, you can take not only your contributions and earnings, but any money the employer put in and earnings out and put it into another retirement vehicle. You have access to that. I've worked in companies that had this 6 year. So you had to be there at least 6 years, and based on the amount of time you were there before you left, that's how much or what percentage you would be eligible to receive of the employer contributions and earnings. So if you leave after 4 years of service, you get 100% of your employee contributions and earnings, but only 40% of the employer's contributions and earnings. You go to page 13-8. Let's take a look at an example. Suppose, I don't know if this is in here. Yeah, there's the vesting. Let me just make sure. Okay. What if, suppose that in 3.5 years, the balance in Tina's 401k account is $33,000. Tina has contributed $9,000 to the account, and CBA, her company she worked at, has contributed $18,000. Also assume, that Tina is 40% vested in her accrued benefit. So there's the 18 plus 9. Okay. So what is Tina's vested benefit? Well, so of the, let's see, so a total of 27,000. I'm just making sure. Okay. The first part is the $11,000 from her contributions. Take a look. The total balance in the account is $33,000. Okay. Her portion would be the $9,000 she contributed divided by the total contribution between her and the employer, which is $27,000. So basically, we just want to make sure we allocate the earnings related to her $9,000 to her. So that would be $2,000. Now, of the remaining $22,000 in value, total $33,000, $11,000 is attributed to her contribution and earnings on her contributions. So of the $22,000 that is attributed to the employer's contribution and earnings, she is only entitled to 40% or $8,800. So that is her vested benefit. She could leave it there and take it when she retires, or she can ask for a distribution of it and put it into another retirement plan if she wants. She has options there. But the key is that's what she's eligible to take with her in total. Are there any questions on that? I remember learning about vesting going, what? What do you mean I got to wait for money? But it's not your money, it's the employer's money. They want you to stay there. Now, if Tina left after 6 years, She'd be entitled to all $33,000, everything. But it's because she left before she was fully vested in all the employer's contributions and earnings. So 401ks, 403b, 457, all treated the same. Now, just like I talked about when I contribute to my defined benefit plan, employees have to contribute to a defined contribution. That's why it's called a defined contribution. Employers contribute as well. But when employees contribute, they don't pay income tax on that part of their gross pay in the year they make the contribution. It's subtracted from their gross pay, and the difference is what the gross pay that will be taxed, okay, and reported to the IRS. So that means that when you take a distribution at retirement for a 401k, 403b, or 457, all of the distribution is taxed at ordinary rates. Now you have to think about this. What are you taking a distribution on? Your original investment from your gross pay that was not taxed when you earned it, the earnings, which are not taxed as they're being earned, the employer's contribution, which is not taxed when they put the money in, and the earnings from the employer contributions. So this is a deferred income arrangement. We talked about this way back, beginning of the semester, and we said, put the money away now, no tax on it. Take the money out when you retire, pay ordinary rates. Normally your rates are lower when you retire than when you're working. Now here's your early distribution. So anytime, any type of retirement, you take an early distribution, meaning you take the money out before you turn 59 and a half years old, and you're still working. Or you're not 55 years old yet and separated from service, and you're no longer working. So when I retire early, I should be about 57, okay? I don't fall under a 10% penalty as long as I'm not working any longer. So if you're 55 years old and stop working, you retire early before 59 and a half, you will not have to pay a penalty when you take that money out. If you retire at 50, even if you're no longer working, and start drawing on your pension before you're 55, sorry, you have a penalty. Now, here's a little CARES Act exception. Taxpayers do not have to pay the 10% penalty if you took a distribution in 2020 because of coronavirus. And really, how are they going to prove it's not? Okay, but if you, I worked all through this disaster. I was very lucky. I was able to collect my normal paycheck, keep working, no problems. But what if I was a bartender or, a waitress, or whatever. I worked at a place that, like a hairdresser or something. These people shut down, okay? Now, if I needed to take a distribution because I couldn't pay my bills, I was having a financial hardship because I couldn't work because of this virus, the distribution I take won't be taxed, okay? So first of all, they're not subject to a 10% tax for the amounts you take less than 100,000. Further, you don't need the financial hardship for this second blurb, okay? If you took it out from a financial hardship, you don't have to pay income tax on it even, as long as you repay it in 3 years. It's like a loan. They don't let you take loans usually from your retirement, okay? But in this extreme circumstance, that's what they're allowing for 2020. Now be careful of how much you take out, okay? But normally subject to a 10% penalty. But with the current situation, they're waiving that. Now, when you start taking your money out, first of all, crazy, but first of all, you have to start taking money out. You have to, a minimum amount when you reach 72 or when the employee retires, whichever is later. So for the year in which an employee reaches age 72 or when the employee retires, so some people work past 72. I know there's some people up at the school at LCC. I'm like, when are you going to retire? I don't know how, somebody in their early 20s can relate to you, but I mean, I think you guys have a hard enough time relating to me. So I can't imagine somebody in their late 70s, early 80s, but some people do. Look at the later of the 2 years. For each year and subsequent year, okay, you have to take a minimum amount out of your retirement. Now, the first year, you either reach age 72, okay, or you retire, whichever is later. In that first year, this has to happen. You could wait till April 1st of the next year to take the money out. It's called a required minimum distribution, an RMD. But every year after that, you have to make the distribution by that December 31st, or you're going to be penalized. And it's 50% of what you don't take out that you were supposed to. Crazy. They base the amount you have to take out on a percentage and the balance of the account at the end of the year. Now for 2020, they're not making us take the money out. Now my father is like thrilled. He calls me, he goes, I heard, you got to hear my father, but I heard I don't have to take my money out this year. Woohoo! You know, I'm like, no, you don't, Dad. But why does he care? Because he's taxed on it. And he's like, if I don't need it, why should I take it out and pay income tax? So the government wants us to start taking that money out. So we pay income tax on it. So that's why they do it. But you don't have to take anything out in 2020. Let's take a look at an example of a defined contribution plan. Before Dave retires at the end of 2019, he continues to contribute to his company-sponsored 401k account, which if you haven't noticed, 401k is the code section in the Internal Revenue Code that defines these types and gives the rules and regulations and taxability of this retirement. 403B is that Internal Revenue Code, and 457 is that Internal Revenue Code. CBA matches employee contributions on a 2-for-1 basis, up to 4% of the employee's salary. Dave is 72 years old at the end of the year, and he earned a salary of $490,000. Pretty nice, Dave. No wonder you don't want to retire. Dave contributed $26,000 this year to his 401k. How much can CBA contribute? So this isn't on how much distribution or required minimum distribution. This is on the contribution side. Remember, we said there's only so much an employee can put in, and then there's only so much overall that can be put in by the employee and the employer. So I think this one, let's see if this is in here, Dave, probably not. Oh yeah, it's on page 13-7. And actually that should be probably 2020. Dave retires in 2020. They didn't update the dates on the PowerPoint. Here's your answer. Dave is over 50. The maximum amount of money that could be put into Dave's 401k by him and his employer is $63,500. He contributed $26,000. That difference is what the employer can put in. Now, if there was no limitation, the employer could put in up to $39,200. $490,000 Dave's salary. They contribute 2-for-1 up to 4%. So 4% times 2. So That's how we determine the overall amount an employer can contribute. No. Contribution limits. And by the way, remember, Dave here can put in 26,000 because he's over 50. It's 19,000 for someone under 50, 19,500. Those of us over 50 or over at the end of the year, 26,000 is our contribution. Overall contribution, 63,500. Assume that when Lisa is 57 and still employed by CBA, she requests and receives a $60,000 distribution from her 401k account. What amount of tax and penalty is she required to pay if her marginal tax rate is 32%? Remember, no matter when you take a distribution, it is taxed at ordinary rates. That should be 32, by the way. 60,000 times 32%. Man, this one, somebody didn't proofread this. So her normal tax is 19,200, which the tax amount here is correct, but this 32%. Because she's under 59 and a half, still working. Even though she's over 55, you have to separate from service. You can't be working anymore. So she's going to pay an additional 10% penalty or $6,000 on that money. Now, if it's 2020 and it's the CARES Act, okay, she can take up to $100,000 out with no penalty. If she took it out for a financial hardship, she doesn't have to pay any tax on it at all. Taxes or penalty as long as she pays it back in the next 3 years. So that's how the CARES Act would work. Let's look at the minimum distribution now. So now that is take it out normally. We got Dave here. He retires from CBA in 2020 at 74 years old. Assume his 401k account balance is 3.5 million. What is the amount, the minimum distribution he must receive for 2020, and when must he receive it? Now we're going to do first, that's the normal rule. Assume that the distribution requirement is not waived under the CARES Act. So this CARES Act is the one that came out and said, you don't have to take anything out, Dave. So in 2020, that's what applies. But after 2020, back to this original rule. So here's what Dave would have to do. How much is the account balance in Dave's retirement? Find this. You go to page 13-10, you look up the age of the participant on the uniform a lifetime table, 74. Okay, go across applicable percentage. He must withdraw 4.2% of the balance as of 2019 during 2020. However, since this is his first year of applying this rule, he has till April 1st of next year to take that 147,000 out. Now, in 2021, by the end of December, he has to take, when he turns 75, 4.37% of whatever the balance was in 2020. So he's going to have to take out two amounts in 2021 if he waits until 2021 to take this 2020. Okay, so it all depends on his situation. Because if he's still working in 2020, his salary could throw him into a crazy tax bracket. It may be worth waiting until next year to take this out and have it taxed on next year's tax return when he's not working anymore and making $500,000 a year. Okay, so you got to look at the situation. Remember though, in 2020, because of the CARES Act, he doesn't have to take anything out. He doesn't even have to take this out as of April 1st of 2021. He could just take his normal distribution out, well, his minimum distribution for the 2021 year next year, and not worry about the one from 2020. All right. Any questions? My dog is sleeping behind me. Now, so we talked about defined benefit through an employer, defined contribution through an employer. Now let's talk about you decide to go and set up your own retirement plan. And these are commonly referred to individually managed qualified retirement plans, or simply IRAs, individual retirement plan. One person owns it. So you can't have a husband and wife, one IRA. Husband has an IRA, wife has an IRA. There's two major types of IRAs, or individual retirement accounts. These are usually purchased through maybe an insurance company, an investment company, or your bank. Your bank offers them. Now, the first one is what we call the traditional IRA. The second one is called a Roth IRA. Traditional IRAs, individual retirement accounts, came out, I think, during the 1970s, developed by Congress as a tax vehicle for people to save money for retirement. So they weren't counting on Social Security. So what Congress said is, let's develop this investment vehicle. Let people put money away in it, especially if their employer doesn't offer them a retirement, like a 401k, clients, a defined benefit or defined contribution. Hold up a second. Go outside, Mark. Go to the bathroom. Go ahead. Okay. That's a boy. Stay in the yard. Okay. So they said, let's offer this to people to go and do it. And let's give them a tax incentive to do it by offering them a deduction for AGI on their tax return. Okay. Now, as we said, it's a for AGI deduction. You deduct it to calculate your adjusted gross income. If you are not in an an employer-sponsored plan, so you're not in a defined benefit, you're not in like a 401k or a 403b or 457, you ain't got nothing at your employer, okay? This is a great investment vehicle. You can deduct and contribute, okay? You can contribute and deduct as a for AGI. Now, two things, contribute and deduct as a for AGI contribution. $6,000, the lesser of $6,000 or earned income. You have to have earned income. So you're either working at a job or you're self-employed. The lower of those two amounts, you can contribute and deduct if you have no other retirement plan. Now, if you're 50 or older, your number goes up to the lesser of $7,000 or earned income. They give us an extra catch-up of $1,000 because we're getting old. They want to make sure we have enough money. They don't want to limit us, especially if we haven't been saving. People, when they turn 50, are like, I better start saving for retirement, you know? So they allow that. Now, remember what I said. Traditional IRAs are good for people who don't have any kind of employer-sponsored retirement plan. They get the full enchilada here. They could deduct up to their contributions, $6,000 or earned income. You don't have to put $6,000. You could put, but it's the lesser of the two, $7,000 if you're 50 or older. Now, what if you are married and only one spouse works? Okay. Or one spouse is in a retirement plan. Well, first of all, the non-working spouse does not have to have earned income. the working spouse can put the lesser of $6,000 or their earned income into their account, and the wife's or the husband's account, the spouse's. 7,000 if they're over 50. Where the issue comes in, and you might be reading through this, is when, let me see. Oh, by the way, before I go into the issue, you do not have to make the contribution tax year that you are deducting it. So if you want to see, I want to see where my tax return ends up for 2020. And maybe I'll decide if I'm going to make an IRA contribution then. I had a taxpayer who would do that. He'd go, Laura, figure out my taxes. What's my refund? I'd say like $3,000. He goes, okay, make that an IRA contribution, because he didn't have an employer sponsored plan. And he goes, and then I'll put the money in my IRA by April 15th. So essentially, say I was doing his 2019 tax return, I would deduct $3,000 as an IRA contribution in 2020 when I was working on his tax return. As long as he got that money into his IRA by April 15th of 2020, he's allowed to do it. So you don't have to make the contribution in 2019. You wait till April 15th of the next year and still get that deduction on this year's tax return. Now, before I go into this, I don't like this PowerPoint, so I'm going to take you to the book because I want to go over a couple things with you here. Where is it? One second. I guess not. Let me go back and go over a couple things that you might have noticed on the slides here. For single taxpayers, you are allowed, okay, you are allowed a deduction of a contribution to a traditional IRA, sometimes even if you are an employer-sponsored plan. So let's say you're single or head of household, you have a 401k at work, and you have a traditional IRA. If your AGI is below certain amounts, I thought they put them in here. I'll grab those for the supplemental discussion I make on this. But if they're below a certain amount, you still may be able to deduct all of your contribution up to $6,000 as a for AGI deduction. So just because you have an employer-sponsored plan doesn't mean you automatically cannot deduct contributions to this kind of plan. Another thing, you can contribute, even if you're in an employer-sponsored plan, up to $6,000 or earned income. If you're an employer-sponsored plan, you may not be able to deduct all of that contribution. So contributions are not limited because you are in a retirement plan at work. It's the deduction that may be limited. Married taxpayers have that same situation. If both, it's the lesser of 6,000 or earned income of both spouses, reduced by other spouses, okay. They have the same situation. If one or both married taxpayers are participating in 401ks at work, you can still contribute up to that 6,000 or earned income. That doesn't stop. The deductibility may decrease because of your participation with that employer plan. They used to go into detail about how to figure that out, and it's not in here now, and I don't know why. So I'm going to take a look at it. I do want to go through that so you can see it, how we determine how much is allowed to be deducted. So what I want you to take away from this is that if you want to have a traditional individual retirement account, you can contribute no matter what, up to $6,000 or earned income. It goes up to $7,000 if you're over 50, but you can deduct it all if you aren't in an employer retirement plan. You may be limited to the deduction if you are. And that's what I need you to take away from that. That's the contribution to the individual retirement account. Let's go to this. I'll come back to that in a second. What's the other IRA? It's called a Roth IRA. And these are great for you young people. Okay. Somebody who's not really close to retirement. You can contribute up to $6,000. It's the same kind of limitation, $7,000 at 50 or over, to this individual retirement account. Now, unfortunately, if your AGI is at a certain level, you may not be able to even make a contribution. So AGI could limit the amount you could even save. None of the contributions you make, no matter what, are deductible. You can never deduct contributions to a Roth IRA. You may be limited to the amount you could put in because of your AGI. And nobody cares for this kind of IRA if you have any other retirement account. That doesn't impact anything. It only impacts the traditional IRA. Now, if you're going, well, what's the big thing about this? Here's the big thing. If you leave that money in that account, you leave that account open for 5 years, beginning January 1 of year of first contribution. Before you start taking any money out, none of it's taxed. None of the distributions are taxed, not $1 of them. So you have to leave that money in there from the first year you opened it for 5 years. Even if you just made a contribution, as long as it's open for 5 years. Now, once you start taking money out, none of it's taxed. What happens if you start taking out before 5 years? The earnings part is taxed. Your original contribution won't be taxed. It's just like a return of capital. The earnings will be taxed. Further, those earnings may also be subject to a 10% penalty from an early withdrawal. So those early withdrawal rules apply to IRAs as well. Now, if you also start taking money out before the 5 years, and it's because of death, well, you wouldn't, but your beneficiary takes money out because of death, or if you take it out because you're disabled, or you take the $10,000 out to purchase a home, not taxed. It's not taxed. Okay, not even the earnings. Okay, so the important thing here is that if you take the money out before 5 years, earnings are taxed. If you wait till after 5 years of having this open, none of it's taxed. Now let's take a look. I kind of bypassed it. What happens with these individual retirement accounts, the traditional ones? If you were able to deduct your contributions as you made them, all money taken out when you reach 59 and a half, there's that 59 and a half, is taxed as ordinary income, just like your 401k would be taxed. Okay, there's certain exceptions. If you took the money, well, there's certain exceptions. If you start taking the money out before 59 and a half, you'll be penalized. So not only will you pay ordinary tax, but you'll pay that 10% penalty. Unless you take it out to pay for medical expenses, insurance premiums, health insurance premiums, $10,000 to buy your first home. It's for childbirth or adoption expenses, or there's that coronavirus related distribution. That's the only time you won't pay a 10% penalty. So you got to be able to prove that. You also may have to take out a required minimum distribution, but remember, it's not required in 2020. One last weird thing with these individual retirement accounts. Remember what I said? You can contribute up to $6,000 or earned income, whichever is lower, but you may not be able to deduct it all. And I'll bring this up in our conversation when I do my video, because I know we're nearing the end. The non-deductible contribution, the part you were never able to deduct, okay, that part of your distribution will not be taxed. Okay, and I'll give you an example of that when I go through my video. I'll start with that. Okay, and I'll review these different IRAs. I'm going to get those numbers for you as well. Just give me 2 minutes to wrap up. Assume Tina graduated from college, began working for CBA. She made a fully deductible $4,000 contribution to a traditional IRA. 3 years later, when her marginal tax rate is 22%, Tina rolls over the entire $5,000 account balance into a Roth IRA. So now she's going to switch her investment vehicle. Does she have to pay tax on this? The answer is yes. Okay. And she must pay $1,000 in taxes. So if you move money from a traditional IRA to a Roth IRA, traditional IRAs are taxed when you take a distribution. Roth IRAs are not. So they want to tax that money now because you're not going to be paying taxes on the Roth distribution. So she'll be paying $1,000 tax. She won't have any early distribution penalty. She's not taking the money out to use for herself. She's putting it right back into another investment. And we'll talk more about that on our presentation on Thursday. Wow. Okay. So that's not the overall end of our presentation. I have the slides I want to talk about on Thursday in their own area, but that's what I wanted to talk about today. Oof. Remember, I'm not going to be able to have class on Thursday. I apologize for that again. Let me get back to our stop sharing. Okay. But I will get a video together. I'll send you the link. Please remember all the due dates coming up, okay? And if anybody wants to meet with me individually to discuss any kind of issues you're having with the tax project or the Chapter 13, I'll make myself available and we'll set up a meeting here in Zoom and we could discuss those things. If any of you as a group want to get together and talk to me about your group project, we could do that as well, okay? It's not a big deal. So are there any questions right now? Well, I thank you very much, everybody, for a very nice semester. I know you're a quiet group, right? It's a little weird learning this way, I know, and I hope you take away a greater understanding of at least our individual tax code. And I wish you all the best. Take care, everyone.
Have a great one. Thank you for a good semester.
You bet. Take care.